Well, this week there's two key events to discuss. So the first is the Westpac Melbourne Institute Consumer Sentiment Survey for the month of March here in Australia. And the second is the ECB decision, which we saw overnight in Europe. Starting off with the Consumer Sentiment Survey, what we saw there was about a 2-point decline in the month of March, taking the index down to 99 or around about there. And that's really consistent with pessimists outnumbering optimists to a slight degree, although it is roughly in line with the average we have seen over the past 9 months. And that's above where we were pre the change in government last year when Turnbull took over. So we have continued to actually see that those gains that we saw at that time persist, albeit we are at a slightly, less optimistic level in the month of March. In terms of the components of the survey, the key things to note really are that family finances relative to a year ago remain quite weak, and they actually have declined a bit further. So obviously the uncertainty that we have seen play through and the slightly softer sort of labour market conditions with the unemployment rate around about 6% are impacting people's perceptions of their wealth and also their ability to earn income going forward. And that is having an impact on sort of their spending capacity, with time to buy a major household item also down in the month. That being said, they still remain relatively optimistic in terms of the outlook, so they are more positive on their family finances looking for the year forward, and also on sort of economic conditions on a 1-year and 5-year outlook as well. So that does sort of emphasise, I guess, that we are likely to see a firming in conditions and in spending if we do see a continuation of the gains we have seen in employment, and we don't see any particular large rise in the unemployment rate going forward. In terms of how that actually plays through into people's perceptions around investment, we have seen the uncertainty we've seen in financial markets, and also, I guess, the sort of angst potentially around the labour market lead to people to be a little bit more risk averse. So we have seen quite a significant shift towards pay down debt, as well as deposits and debt instruments, as opposed to equity and real estate. And so that's to be expected given the volatility we have seen, but it does emphasise that people are likely to take, I guess, a more risk adverse posture with regards to their investment and also their spending in the near term. With regards to the other detail we have around the housing sector from this survey, it is a positive that we have seen, I guess, a stabilisation in those indexes. So both on house price expectations and also whether now is a good time to buy a dwelling, we have seen a stabilisation and a bit of an improvement over the last couple of months, and that's what we're hoping to see that continue on over the next couple of months and see an improvement move through. In terms of sort of the overall expectation around housing, those survey components do really continue to point to modest price growth, particularly in sort of New South Wales and Victoria, well down on what we saw in recent years, but still quite positive. And that sort of should continue across the rest of the country, albeit caveated with obviously significant concerns around sort of the labour market prospects for WA and also other sort of mining areas around Queensland and sort of other states as well. Shifting across to Europe on a completely different tact, we saw the ECB last night stand and deliver further accommodation above expectations. So they have decided to not only cut the deposit rate by a further 10 basis points down to minus 0.4%, but they've also cut their main refinancing rate and other rates by about 5 basis points. So it takes their main refinancing rate down to basically a flat outcome. And so that's sort of one part of the picture. In addition to that, they've also decided to increase their purchases by 20 billion a month, so it takes that monthly purchase pace to 80 billion. And they've also decided they will allow for corporate bonds to be purchased as well as part of that. So that sort of broadens the base of assets which they can actually seek to buy to provide liquidity to the system. In addition, they're also introducing a further set of long-term loans which can be taken up by the banks to provide them with greater liquidity. And a little novel sort of addition to this measure is that they're actually being willing to actually pay the banks to actually borrow if they actually then on-lend those funds in the form of loans to the private sector. So that's going to be quite key to actually see how that actually evolves and whether the banks do actually take that opportunity to actually invest in further loans and actually into the real economy. We do remain relatively, I guess, dubious in terms of believing that this will come through, particularly in the short term. We have seen the banks remain very, very constrained in terms of their lending, and that's likely to remain the case as they remain concerned about the sort of overall economic outlook for the euro area and also for the global economy. So if this does work, it's going to take time, and there is a definite risk that the ECB will need to do more. On that point, there is a concern that whether they're, I guess, lacking the capacity to do a lot more. We have seen them really broaden that asset base of potential assets they can purchase quite considerably, and there's really not all that much more room to move on that front. And given the deposit rate is down at -0.4, there's not necessarily a lot of room for them to continue to cut the deposit rate, particularly given the impact it has had on bank profitability so far, or at least risks around that. So it's going to definitely be a watch and wait scenario, and it doesn't mean the risks around Europe are off the table at all. They are still quite significant, and growth is likely to remain quite soft there for quite a foreseeable period. Looking to next week, again, there's sort of two key releases. First in Australia for the labour force release. After, I guess, a little bit of a surprise with the unemployment rate increasing to 6% last month, we're looking for likely a further tick higher in the unemployment rate, albeit with employment growth coming back and seeing a modest gain for the month. That's really been driven by participation then, that increase in the unemployment rate. From here then, we'd likely see, I guess, a stabilisation in the unemployment around about 6 or a little bit higher over the next kind of 6 months or so, and then it start to improve next year and actually see a more meaningful trend down sub 6%. That's really going to be quite key for the RBA's outlook as to what happens to the unemployment rate and also what happens with employment growth, because that's going to be driving household income. The other key event next week is further policy decisions with the FOMC meeting in the US. There's no expectation really that they will hike rates again this time around. They want to allow, I guess, the markets to take breath and actually assess conditions. Albeit, if we continue to see, I guess, the uptrend we have seen in equity prices and the continued robust momentum on the domestic front, they are likely to start to raise rates from June. So we'll come next week and wrap all that up for you.